Successful day trading operates at the speed of a high-density data center. It is a highly structured environment, where every decision is driven by real-time data and strict technical parameters. This guide breaks down the specific technical stack and the mathematical steps required to navigate these markets within a risk-free testing environment. To start, you need to meet the baseline requirements: full-time attention during market hours, a highly reliable internet connection, and the emotional discipline to execute a plan without hesitation. In the United States, the pattern day trader rule requires you to maintain a minimum capital balance of $25,000 if you intend to actively day trade stocks. You can bypass this capital requirement entirely today because your initial strategy will be executed in a simulated paper trading environment. Treating a $0 simulator with the exact same gravity as a funded account is the only way to build the habits necessary to survive the real market later. Step 1 is securing your technology stack. You need direct market access, or DMA, which routes your orders directly to the exchange to avoid price slippage when seconds matter. You also need Level 2 market data to view the full depth of the order book, paired with responsive third-party charting software like TradingView. This image captures the rapid price fluctuations you will navigate. Day traders operate on 1 to 5 minute timeframes, requiring snap decisions as these real-time quotes update. Your next step is to open a demo account with a major broker that supports this high-speed infrastructure. Once your account is active, establish an unbreakable rule: you will backtest and paper trade within this simulator for no less than 3 months. The goal of these first 3 months is not to generate fake profit. It is to build physical muscle memory with your platform and learn exactly how to stop losing money. To stop those losses, you need an ironclad barrier before ever clicking a buy button. We use a mandatory 5-point risk checklist. This manual outlines exact variables you need. First, define your exact entry price and your precise exit price, which is your stop loss. Point 3 calculates your risk per point. Finally, points 4 and 5 cap your maximum risk to a tiny fraction of your total capital. This checklist forces the trader to answer the most difficult questions before the price begins to move. By defining the exit before the entry, the system dictates the action, removing the need for mid-trade guesswork. Let's translate this theoretical checklist into a practical trade setup on a live price chart. Traders use recent price action to identify safe areas. On the left, a swing low formation provides a structural place to hide a stop loss below the wicks. Conversely, the swing high on the right places your risk parameter just above the recent peak. On this standard Euro JPY order ticket, you input your calculated stake size into the quantity field. The most critical action happens right here. You must check the stop box and input your exact stop loss number before confirming the trade. The moment you click buy with that stop loss attached, you are mathematically protected from unpredictable market crashes. You now know how to execute a fully structured, risk-managed day trade. There is one absolute final rule: every single open position must be closed out before the market shuts down to completely eliminate overnight gap risk. Your immediate homework is to take this framework to your simulator. Repeat the exact process of the 5-point checklist and simulated execution 100 times. Track your data carefully. Generating consistent profitability across 3 consecutive months in the simulator is the only acceptable metric to graduate to real money. Staying in the game requires repeating this exact sequence: checklist, execution, and exit, until the process becomes a standard operating procedure.